All right, so we're going to talk about liquidity. What I'm going to show you today would be normally reserved for students that are in my mentorship, but I want you to appreciate the level of systematic delivery of price, why it does what it does, and try to just simply suspend your belief system on any other model or school of thought. Like if you're a supply and demand, follower, or if you're an Elliott wave trader or a harmonic trader. All right, so we're looking at the dollar CAD, and this is a pair. Admittedly, I don't trade a lot, but if I don't get a setup in euro dollar or pound dollar, I will sometimes resort to trading this pair or the Aussie dollar. Okay, so I just want to toss that. I want you to think about some general themes here. Again, I mentioned the L7 range theory, and it's basically trading inside the range. When we're looking at liquidity, okay, the easiest way to determine that is anything that would reside above a short-term high or an intermediate term high. Now you might look at this area here and say, which one's the high? Well, this candle is slightly higher than all of them, but whenever I see multiple candles or multiple levels that look very close to one another in height or in depth in terms of the lows, if we're considering the opposite in terms of looking for sell side liquidity, buy side liquidity rests above old highs. Now it can come in the form of these areas like this where it's relative equal highs. Okay, that's one of the concepts that I use to frame the idea and understanding of liquidity. Now, liquidity can be formed on the basis of a single point of reference, like this high or this high or this high, or it could be a collection of relatively equal highs or relatively equal lows. Like this here, this would be considered relative equal lows in my school of thought. This is relative equal highs in my school of thought. This is a single buy-side liquidity pool, old high. This is a single buy-side liquidity pool, short-term high. These things, okay, are not required for a label sense. It's just I'm showing you the contrast between the two, but generally anything above an old high would be buy-side liquidity. That means there's buy orders up there. Now, as a new trader, that sounds a little alien. It doesn't make sense. Who would be wanting to buy up there because your books are telling you buy low, sell high? There's always traders that are going short or traders that want to buy on a breakout if it goes above that. So that's the context of why that's buy-side liquidity. And I teach it from a institutional perspective. I'm not looking at it in terms of saying, this is a resistance level. I'm teaching that this is an area where there are willing buyers up there. The main common denominator is the markets are manipulated. And they're manipulated not on a random basis, but they're manipulated with a rule-based structure. So I'm going to give you a little bit of the details and how you can start looking for these types of signatures in price. So if you look at this dollar CAD, we have an old low here and price has rallied up. Now, retail logic states that we have this low as a support level. Why? Because price moved away from there. We don't go into describing why it would have turned there from a retail trader. I see this as a liquidity pool of sell side orders. Okay, sell side liquidity. Anyone that would have an order below that would be a seller. They want to sell. Why would they want to sell below that? Because anyone that's long here or even chasing price, they're going to look back to this level and feel confident that, well, it bounced there before. So even if it starts to come down, which may be very uncomfortable for them, they have belief and faith and confidence that their books have indoctrinated them into believing that this is a level that should prevent price from going lower. And I used to think like that until I lost thousands of dollars. And then it quickly dawned on me that I'm probably not following the right things. So I want you to think about that low with the target or bullseye of the price wanting to go down to that level to attack the liquidity that rests below that low. Now, it may take months before it gets to this low, but if it gets to this low, this is what I want you to start looking at. And it doesn't only work on daily charts. This works on hourly charts, it works on 4-hour charts, it works on weekly charts. Okay, so it's important that you know that this liquidity idea I'm teaching you here is just part of the framework. But we can see eventually on the 9th of November, price trades down and goes below that low. This is an important event. When this day runs below this low, it's a crucial event algorithmically, because what it's doing is it's going into a pool of liquidity. Now, we don't know with any absolute assurity that what I'm going to outline here is going to unfold, but I'm going to give you the things you look for to build confidence that it is likely to. And you'll see by going through your own charts how fast you can see these scenarios developing. We're going to go down to an hourly chart and study this fractal where it goes below this low here. I'm going to release information to you that would otherwise not be shown on my YouTube channel. So let's go over to the hourly chart now. All right, so here is the hourly dollar CAD chart. Now right away, it probably doesn't look like much to you, okay? But I'm going to add the annotations in a moment, but I want you to take a look at some of the things without having any scribbles, any kind of annotations or markings or labels on the chart. Just let me flesh it out for you a little bit, and then we'll throw the lipstick on the chart. You should be able to see this high and this low as a important price range. Now, what makes it important? It's the most dominant price range in this portion of price action. So whenever I'm looking at price, I look for clear, discernible price ranges. When the range is clearly defined, as you can see here, what I do is I want to look for reference points based on measurements that are very generic. Okay, so in other words, I want to know what this high is here on this candle, and I want to know what the low of this candle is. Now, we're looking at this with the expectation that we're anticipating a run below that, but we don't know if it's going to continue. We wait for something to occur, which I'll outline here, and then once it happens, it gives us framework for short-term bias and where the withdrawal and liquidity is going to in an opposing order. In other words, we see an attack on sell-side liquidity with this day here. If something occurs, as I'll outline, that will be your green light to anticipate opposing buy-side liquidity to be taken. Okay, so the concept I'm showing you here is purge and revert. Okay, purge and revert. All right, so when we look at liquidity, you want to be able to look at it on the basis of daily highs and lows. Now, when you look at daily highs and lows, you can add period separators to your chart, like tradingview.com allows you to do. I'm not sure why it takes so long to load up like that, but there it is. But if you put the period separators on TradingView, this is the levels that you're going to get. I don't do it like this. Okay, so what I do is I look at the midnight to midnight time frame, and I delineate my session breaks like that. So it'll look like this. Okay, so all of my vertical lines here are midnight to midnight New York time. Once this low, which is highlighted with this line here, that's that old daily low. And we see that run below the old daily low here. That is a purging of liquidity. Now, once this purge occurs, we want to see the day of that purge. We want to start looking backwards. Okay. And other video series and other videos and other commentaries I've done with Forex and trading technical analysis concepts and such, you'll hear this repeat. 3 days. Okay, I use a 3-day range of look back. Okay, if you look for the last 3 days, you'll have all the liquidity pools you need to make money. You'll have all the liquidity pools to target for your trades. You'll have all the liquidity pools that you could use for trade entries. And you don't need anything other than that. The market does not look back 20 years ago. The market does not look back 5 years ago. Okay? It looks at predetermined price levels, and that's the reason why the algorithms operate the way they do. The day of the purging, in other words, the day it runs below that old daily low, when that happens, we count that as day one. Okay, that's day one of that event of purging. We wait to see if it goes higher and reverts, not reverses. Okay, I'm not saying reversal. I'm saying revert. What is it reverting to? It's reverting to buy side. So it draws to sell side liquidity, and that's counted as day one. That is day one, day two, day three. That's our look back on the day of liquidity purge. So the day it occurs, you look back 3 days. Now, inside the range prior to the liquidity purge, you got to look back and see where is that range. Now, you could have looked at this, say if you're looking at a 15-minute chart, maybe you would have seen it as this high to this low, and that's fine. There's nothing wrong with that. You would be just using 5-minute charts to get the same premise I'm showing you here on an hourly chart. It's all scalable, folks. And this is an example of engineered liquidity. Engineered liquidity is where they run down, take those sellers out of the marketplace. For what purpose? It allows individuals that are on the smart money side of things, informed traders, okay, large institutional traders, bank traders, and they will use that liquidity to be a counterparty to their buying. So it is a way of looking at price and saying, okay, I don't need to have an overbought, oversold indicator. I don't need to have a divergence in an oscillator. I don't need to have harmonic on my side. I'm just looking at where liquidity is. And if we see an old daily low taken, that is a significant pool of liquidity. There's lots of orders below an old low, like I indicated on the daily chart before transitioning to the hourly. But this event where it goes below that low, if this is true, if my assumption and my argument that I pose to everyone that comes to me, if these markets are not 100% manipulated by an algorithm, then the things I'm going to show you here won't hold up. If price runs below an old low, that sell side liquidity has been purged only if we start to move away from it. Now, it might be a sweep on stops and then it continues higher. But if it runs below it and then goes back above a specific level, what level would that be? Well, we want to look at the day that it occurs and it runs the liquidity out. So this day here, I've annotated the daily high. If that high is traded to and through, that is a market structure break. Only on the basis of a liquidity purge. Now, it does not mean it's 100% successful. It just means that from an algorithmic standpoint, if we're looking at logical steps of processes, we look for this. If this occurs, then we look for this. If that occurs, then we look for this. And if that occurs, we look for that. So it's a matter of looking at a recipe for a model that would be unfolding dynamically. So if this day's high, when it takes the liquidity out, is broken on the upside here, I don't need it to close above it. I don't need that, because the narrative is it ran below an old low for liquidity. If it's going to go higher, the algorithm will start its macro, and macro is a short order of processes that begin and go step by step. And it's like a small little algorithm in a sense. And the large algorithm that creates and controls price action, it's just a bunch of smaller little algorithms that tie together. So the run below the liquidity, if that day's high is broken, we see it here. Then we can start looking for buy side liquidity for the algorithm to revert to. Here's the previous day's high. That's all these little blind segments are. I'm looking at the daily high that is between 12 and 12 midnight each day. So this day's liquidity is taken out, but it's a break in market structure on the basis and narrative that we've taken sell side liquidity out. So now, once it does this, where do we anticipate price going to? Well, you first have to revert back to this high and this low. So we're looking at how much we're going to retrace from this low into this high. It may not ever get back to that high. And then here's the thing. You don't need to have it go there. But you need to know where the midpoint is. And that's what this level is here. So that's basically equilibrium between the high and the low of that obvious range. Now, the algorithm knows this range high, and it knows the low it forms here. The midpoint is equilibrium. So what we're doing is we want to look at 3 days back as far as, in terms of time, the liquidity above the daily highs as far back as day 3, and the filter is the midpoint or equilibrium of the range that it's traded in prior to the liquidity being purged. But the range needs to be filtered. Okay, once we get to the 50 point or 50% level of the high and the low, that's all I really use a Fibonacci for, folks. I'm just looking for equilibrium. And anything at or above it, in my mind, is expensive. In other words, it's a premium market. So it's going to require a whole lot more for me to be a buyer. And many times it will negate me being a buyer. But it will not disqualify a long entry that I have maybe entered, and I did not, so we are clear now. I didn't take a trade on this. I'm just showing you conceptually how you can study and see these things going forward. But you can use these ideas to frame the logic on holding long positions or partials to get to this level, and then day 3 in this case here. So what do I mean by that? We have the high, the low, the logic behind the run on stops on the sell side liquidity raid. Okay, so this is purged if we get a run above the day of the purging. And then we start looking at the previous day's highs, and above that is going to be liquidity until we get to the 50% level of the range. Once it does that, we are in an iffy, like it might not continue going higher. It could, but it might not. But if we have day 3 still in close contention with this level, in other words, it's not that far above it, and it's not a lot of range in terms of where the equilibrium is and where the previous day or day 3's high would be, that buy side liquidity would be potentially attacked. So we can see each day on the 10th of November, we had the break above the old high here. Market structure is broken, so now we're thinking buy side liquidity is going to be the next draw. That means your bias on a short term is look for this high to be tapped, and maybe this one. We don't need it to go all the way back up here. Okay, we don't need it to go all the way back up to the last up close candle, which is a bearish order block. Okay, you're looking at high probability. High probability. This is what this is. High probability short-term trading. So if we see that they're all on buy-side liquidity is the context that the algorithm is going to be operating under, they've already done the damage by going down. But look back is 3 days. Equilibrium is the high, the low, split in the middle. So all I did was to get that level, you put a Fibonacci on this high to this low, and whatever the 50 level is, you annotate that on your chart. So each day after this day, you are looking for this pool of liquidity to be traded to and this pool of liquidity to be traded to. And once it does that, high probability goes away. It changes. Okay, so the algorithm goes into a different mode of delivery. It can become a deeper retracement, or it could accelerate into that high. And we're going to draw this one out in time. Okay, and this one here, because it's above the 3, and it's the last one. So if we continue with that bias, we'll see if there's any continuation of that logic reaching for buy-side liquidity. All right, so now we have buy-side liquidity here, buy-side liquidity here, and buy-side liquidity here. And we're going to look at the 11th of November, and we're going to look at that on a 15-minute chart. So let's drop down to the 15-minute time frame and look at this here and how it attacks these blue levels. All right, so here is the 15-minute time frame of that dollar CAD, and we can see the short little lines are always going to be individual daily highs. The elongated blue lines are going to be those old liquidity pools that we're looking for price to trade up into. So on the 11th, we have price trading in here. And again, all I'm annotating here is this candle's high, which makes that high. We don't use the midnight high when we're looking at all this data here. If this midnight candle makes a higher high, we don't call the 11th daily high that one, because it's really technically the 12th. So you're using only the data that makes the individual day prior to midnight in New York time. So the highest high and the lowest low, that's what we're looking for. But as soon as we get to midnight, everything starts new. That's a new range for the day. So we have equilibrium here. So we know the price could jump to that, or at least this level here. And this level is the initial one because it's below equilibrium, and it's the old liquidity pool on day 2. Look at how price trades back down in to this run here. Isn't this an optimal trade entry? Watch. Here's your swing low. All right, so here is the Fibonacci laid on that price swing. I'm using the bodies of the candles. Again, not using the wicks and the tails because the bulk of the volume is in the bodies. So it's going to give you a pure read on where the buy signal is going to be. All right. It doesn't mean that you can't use the wicks and the tails. It just means when I'm looking for optimal trade entry, I prefer to use the bodies of the candles because it will give you a pure read on the entry. If I'm looking at ranges, okay, like what I outlined on the hourly chart and showed you where the high was and the low was and then did the 50%, when I'm looking at finding equilibrium, I will use the wicks and the tails. The bodies are going to give me the pure entry point. The wicks and the tails are used just for measurement of ranges. Okay, so if I'm going to look for a pattern of entry, I'm using the bodies. If I'm looking for equilibrium measurements, then it's always going to be wicks and tails. So we have the optimal trade entry in here, it trades down to that, and we have a standard deviation of -1/2, and it overlaps basically with that old liquidity pool. And then we have it trading up to equilibrium here at -1. We have -2 just above the old liquidity pool. Then we have -2.5, which is with this new liquidity pool on Thursday before Friday's trading. And the market trades there on Friday. And again, we have price trading down initially, creating a Judas swing. What's the context? We're looking for price to revert back to buy side liquidity because it's already done its job over here, running that old daily low. So each day we're looking for clues if it's going to go to the buy side liquidity. Each day it's going to be reaching for a specific level of liquidity. It's not guesswork. It's very easily discerned what is the previous highs. Where above that high can price reach to? Then price will start stair stepping towards that. It's not respecting trend lines. It's not respecting patterns. It's respecting where the liquidity is. Okay? The market's going to go where there are orders. It has no regard or respect for anybody's trading pattern. Okay? The market's going to go where there is counterparty. Period. And if there isn't enough counterparty there, the market will create it. It'll engineer it. It'll run up, blow out equal highs. It'll blow out equal lows, and it'll change sentiment on the basis of that event. Here we have the market trading above the equilibrium, trading to an old liquidity pool, and trades back down. Now, we still have time in the week, and it can still continue. But isn't this an optimal trade entry as well? And a breaker. We have a low, a high, a lower low. Use the highest up close candle. I'm just adding this in here just for bonus, no extra charge. We have the body right there. So when the market trades down into that, that's your bullish breaker and your order block. Down close candle before this displacement. Optimal trade entry. We'll add that. Again, watch what I'm doing. I'm putting it on the bodies. We get above Thursday's liquidity pool here, not by much, but we have a standard deviation of -1 that with these equal highs here, or relative equal highs, we could potentially see it try to get up there and snag that. I'm not saying it will because we're above equilibrium, but that is how I would look at it. Now, if this was, say this was Tuesday, Wednesday, and we were still in an active trading week, then I would still be hunting longs, and I would look for standard deviation of -1 or -1.5 because it would be expanding above the relative equal highs, and I would look for it for like 10, 20, 30 pips. And I would look for that type of thing to occur and try to attack that 132 big figure. That is not an analysis. I'm just saying that that's how I would use it if it were, still in an active trading week. In its simplest short overview of what I just did here, you look for areas in the marketplace with old highs and old lows, and if the market trades down below it, wait to see if it wants to break the day it trades below it. In other words, this is the event day. If it trades above that, then we potentially have a market structure shift. So we start looking for previous day's highs and the liquidity that would be resting above it. previous day's high with liquidity resting above it. You are not looking back 3 days every time a new day comes back and then finding that. We are looking at 3 days back, counting day one of the purge on liquidity. That is how the algorithm reads it. How does it select which day, Michael? If there's an algorithm, how does it do it? I'm telling you, this is one of the ways that it does it. It looks back 3 days. Now, why 3 days? You're probably asking, why is it 3 days, ICT? Well, classically, there is and I'll have to show it to you like this. If you're looking at a chart and we're anticipating the lowest candle to go into something like this, generally, that's how as I teach it, there's something down there that we're anticipating. The next candle, if it has a higher low, right away, that's the turning point for me. So we look back 3 days because this event, like it does here, when it runs below that old daily low that's indicated by this line here, when that occurs, it might not just be a 1 day event. It might be a 2 day event where it goes even deeper. So when it creates that, we count that as day 1, 2, and 3. And we identify that liquidity on those days. If it goes lower, I'm still going to refer back to the original day 3. It just gives us one more day of potential liquidity it may reach for. But it's the 3 day on the basis that it creates turning points. And just like everything else I teach, if you just reverse it and put this here, the swing highs form generally like this. We have a higher high, and a candle that has a lower high. Now, this candle's high might be lower than this candle's high, or it could be higher. The real point is that there's a candle that has a lower high to the left, a lower high to the right. And that's usually a classic swing high. Swing low, again, has a higher low to the left, a higher low to the right. And this could be a higher low than this candle, or it could be lower. That's not what we're really pressing here. There is logic behind what I'm showing you here. You can use other things for that, which is a completely different lesson. But for just a classification of a swing high and swing low for turning point basis, this is what it graphically looks like most times. It doesn't always appear like that, but on most cases it does look like that. And that's the reason why the logic is 3 days, because the turning points generally form with that type of structure. But there has to be a logic in play. So let's go back in closing, take everything off and go to a daily chart. The market has consolidated for a long period of time in here. And we have this old low. When the market drives down below that, I don't care if it's going to go up a little bit and then continue going lower, because that's not a model I'm trying to frame here. I'm not teaching you long-term trading. I'm teaching you a short-term way of determining where the next draw on liquidity is going to be. Is it going to be aiming for the buy side or the sell side? Now, there are other ways to discern whether buy side is going to be attacked or sell side liquidity is going to be attacked. And that might be your model. But they all going to lean on general principles that are generic. And that means when we have a period like this in consolidation, this old low, if it runs below that, even if it will go lower, and I'm not saying it will or won't here, I'm just saying if it does, or if it will, or if it's more inclined to do so, all we're doing is looking at short-term liquidity to frame short-term intraday trades. That's all I'm posing that as a study on liquidity here. So I framed it on the basis of higher time frame liquidity pools, which is sell side here, short-term trading logic, algorithmic principles, understanding the open float where the market's going to attack a specific side of the marketplace until it gets to a specific threshold, and then it becomes low probability.